Silver just crossed 100 United States dollars per ounce. That sounds impossible for a common metal, so what changed? For decades, silver was overshadowed by gold. It quietly fueled global industry while investors called it cheap. Now both are moving, but this time silver is the shock. What triggered this sudden runaway surge, and why does it threaten to upend everything, from your phone to the global economy? At 10:47 a.m. on January 23, 2026, silver futures on the COMEX exchange surged past 100 United States dollars per ounce for the first time in history. Silver did not pause. Within hours, contracts touched an intraday high of 100.78 United States dollars per ounce before settling at 100.64 United States dollars per ounce by the close. The market was up more than 4% in a single session. Headlines from Bloomberg and Reuters flashed across trading desks, saying silver broke triple digits and a historic rally shook metals markets. In the same breath, gold hovered just shy of 5,000 United States dollars per ounce, but all eyes were on silver. The so-called cheap metal had just outpaced every forecast, running up 40% in less than a month. Traders scrambled to adjust positions. Some investors watched years of slow gains turn into windfall profits overnight. For manufacturers, the shock was immediate. Raw material budgets were blown in a single trading day. On social media and in boardrooms, the question was the same. Is this a bubble or the start of something even bigger? The market's jolt was not just about price. It was about the sudden realization that silver, long treated as an afterthought, now sat at the center of a new economic storm. In the world of silver, history repeats itself, but never in quite the same way. In 1980, the Hunt brothers' campaign to buy up physical silver and futures contracts drove prices from less than $2 to nearly 50 United States dollars per ounce. Their strategy overwhelmed the market, and new rules from the exchange forced them to unwind their positions. Prices crashed in a single day, wiping out fortunes and exposing how quickly a small market can be overwhelmed by concentrated demand. 3 decades later, in 2008, panic swept global markets. Investors rushed into gold and silver, pushing silver to almost 50 United States dollars per ounce by 2011. That rally tracked gold's rise, and the gold to silver price ratio narrowed sharply. As the financial crisis faded and central banks stabilized currencies, silver retreated. The lesson remained: when investment narratives take hold, silver can move far and fast. From 2012 through 2025, the role of silver began to change. Industrial demand for solar panels, electronics, and data centers steadily grew. New investment products made it easier for individuals and funds to buy and hold silver. Even as the overall market grew smaller relative to demand, deficits became routine. The groundwork was set, a smaller, tighter market ready for a new historic move. Silver is pulled in 2 directions at once. On one side, investors rush to buy when they fear inflation, currency weakness, or global instability. In the weeks leading up to the price surge, safe haven flows accelerated as headlines warned of rate cuts, rising tariffs, and new export restrictions. Exchange-traded funds saw inflows jump 17% in a single session, and retail buyers lined up for coins and bars, chasing the screen price higher. But silver's other engine is even harder to stop. Over half of all demand comes from industry, factories, and manufacturers who need silver's unmatched ability to carry electricity and heat. This metal is found in nearly every phone, computer, and data center. Solar panels rely on it to convert sunlight into power, and medical devices use it for its antibacterial properties. For these buyers, silver is not optional. Contracts must be filled, parts must ship, and production lines cannot wait for prices to come back down. When both investment and industrial demand surge together, the market faces a force that is difficult to absorb, no matter how high the price climbs. Silver supply is slow to respond, no matter how loud the market shouts for more. The system that brings metal to market moves in months and years, not days. Nearly 3/4 of all silver produced each year comes not from dedicated silver mines, but as a byproduct of mining other metals like copper, lead, and zinc. That means silver output is often decided by the economics of those other metals, not by silver price alone. When demand surges, miners cannot simply flip a switch to increase output. New projects take years to plan, permit, and build. Timelines often stretch a decade or more from discovery to first refined metal. Even when prices soar, the decision to dig new ore is driven by copper or lead. Silver alone rarely changes the calculus for a new mine. Recycling offers some relief, but it cannot keep pace with a sudden spike in industrial and investment demand. Smelters and refiners run at full capacity, and the incremental return from recycled material is limited. Major refineries report running at full tilt, yet the flow of new metal remains stubbornly fixed. Production rates do not expand overnight. As inventories are drawn down to fill immediate orders, the market grows tighter with each passing week. Available stock gets moved into the supply chain, and premiums for ready metal can rise quickly. The result is a squeeze that feels inevitable. It is baked into the very structure of how silver is found, processed, and delivered. Here is the twist. Silver does not need to be rare to spike. It just needs to be a relatively small market with a huge story. Compared to gold, oil, or copper, the global silver market is tiny. It is less than 1/10 the size of gold by value, and it is dwarfed by energy and grain markets. When a wave of new buying hits such a compact space, prices can move with astonishing speed. In 2026, a surge of demand, whether from investors, industries, or both, had nowhere to hide. Every purchase, every futures contract, every ounce delivered or withdrawn from a warehouse echoed through the system. A single hedge fund or a handful of industrial giants can soak up a meaningful share of annual supply. That is why the price can leap in days, not years. This is not a story about hidden treasure or sudden shortages. It is about what happens when a market this small collides with a narrative big enough to pull in the world's attention. When the story spills off the trading screen and into the real world, the consequences become impossible to ignore. The price on a trading screen is only part of the story. When silver moved above 100 United States dollars per ounce, buyers who wanted real coins or bars discovered a different reality. Dealers posted premiums well above the quoted price. Sometimes they added 10 or even 15% for immediate delivery. Many popular silver products were listed as sold out. New shipments were delayed or rationed. Retail buyers scrambled to secure what little was left. Even large orders faced wait times and quantity limits. The gap between the screen price and the cost to actually hold silver in your hand grew wider each day. For many, this was the first clear sign the squeeze was not just theoretical. It was playing out in real time, at the counter and online. Behind the scenes, the numbers told their own story. In the first 4 trading days of December 2025, more than 47.6 million ounces of silver were demanded for delivery from COMEX warehouses. That single claim represented over 60% of all registered inventory, an all-time record. The pace did not let up as January began. Warehouse logs showed a 7-day stretch where another 33.45 million ounces physically left the vaults, draining a quarter of what remained. These withdrawals were not routine transfers or accounting shifts. They were real, documented exits of metal, tracked contract by contract. The official records left little doubt. The market's supply cushion was vanishing in real time. Each ounce pulled from storage raised the pressure on prices, as the available pool shrank to levels not seen in decades. A 60-cent premium appeared on near-term futures. It was the clearest sign that scarcity had crossed from theory into the price itself. For a market used to pennies of difference, this gap was a blaring alarm. Momentum funds piled in, chasing the breakout with algorithmic trades that fed on each uptick. Risk-off capital, spooked by headlines and currency swings, shifted into silver at a pace not seen in decades. Every dip vanished in minutes. The price chart turned vertical as buyers crowded into a market with no slack. Analysts called it a textbook squeeze, but the scale was new. A small market, a big story, and a premium that kept climbing even as the trading day ended. Silver's surge exposes a new reality. Even so-called common resources can become strategic flashpoints when supply chains tighten and technology demands soar. As industries and investors adapt, the price of certainty keeps climbing. The age of cheap silver is over. Scarcity now reshapes what we call essential.